Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Briefed now by one of the great optimists, Jeffrey Cleveland, is Director, Chief Economist, Payden Rygel out in Los Angeles. Certainly could brief us this morning. We get perspective. He's had time to digest some of the data. Jeffrey Cleveland with us, with Payden and Rygel. Jeffrey, I'm looking at the market and it sort of says rate cut tilt in place. Do I have that right?
I think the biggest thing I noticed here is August was slightly negative after revisions. So you had some downward revisions. The 3-month average is still pretty meager, 62,000 or so. Yeah. And the direction of travel on the unemployment rate, it appears to be going higher. So we're down 4.4. Right. I think headed to 4.5, 4.6. So I think this does keep the possibility of a rate cut definitely on the table. You see that reaction initially in the bond market, particularly in the front end. So that's the initial read.
And Paul, the single statistic here, which Cleveland, of course, alludes to, is a survey on change in non-farm payrolls for August was 22,000, the reality rather, and it's a negative statistic. Yep. It's negative 4,000
on a revision
on the August report. That's emotional. That negative number is emotional.
Absolutely. How about on the looking at the wage market here, Jeffrey? On an annualized basis, average annually earnings up about 3.8%. That holds pretty steady. So if you've got a job, you're getting paid for it. It seems like.
Yeah, I think that's the positive take here. You still have some modest payroll growth on the 3-month average. You still have wage growth. So overall aggregate income, the consumer still has some spending wherewithal. So this is not a doom and gloom type scenario. Sorry for the bears out there. It's going to create a little more uncertainty over the next few months as we continue to digest this. But it's not a slam dunk data report that points to a recession.
Yep. So what do you think? What are some of the real-time data telling you about kind of where we are today with the labor market? Is this number reflective, or is it just a little bit?
No, I think we do think that all the signs that we've seen through October, November data would point to a higher unemployment rate than 4.4. So something like 4.5, 4.6 would make sense. So that's a bit of a concern. I think also the layoff announcements that we've seen, that's definitely captured our attention. So it's very bond bullish environment. Government bond yields probably on a 12-month horizon are quite a bit lower if we're right.
I look, Jeffrey Cleveland, at this, and I've alluded to this with a couple of conversations this morning. And, I'm sorry, folks, this goes back to what you study at Claremont in school.
Wow.
No, but it's a history, Jeffrey. How can the Fed ignore a fragile labor economy? I get the inflation this, inflation that, fancy mathematics and all that. But the fact is the labor economy's a bit fragile. That's got to be top of list.
I think so. But what does history tell us about the Fed? Usually they're reactive, not proactive, right? So there is an inertia factor, if you will, or a lag between when we think we see something in the data and policymakers take action. We definitely saw that in 21 and 22. I think the Fed was behind the curve there. So it wouldn't surprise me if they were a little sluggish. There are also differing opinions, Tom. I mean, when I talk to clients all year, it's been inflation. If you are able to push back on one of the inflation theories, they'll quickly come up with another. It's been like that all year. So, that's just the focus. And with with inflation still a little bit above target, people still have that mindset. So you need a clear indication to the contrary to really get people over onto your view that maybe labor market is the bigger issue.
All right, Jeffrey. So we got a view here on the labor market today. How about inflation, the other part of the Fed's mandate? What's your view there?
Not worried about it. Okay. When you exclude the tariff pressure, inflation on our view is 2.4 right now, year over year on core PCE. I mean, more or less, if you round that down, it rounds to 2%, I think. So, we're at target if you exclude the tariffs, and we don't think tariffs are an enduring inflation feature. It's a one-time pop to the price level. So we're not worried. And then we see more scope for disinflation, Paul, next year. I think you could see it on non-housing services and, importantly, on the housing component of inflation. So we'll see lower inflation. We could get back to 2% inflation sometime next year, maybe even below 2%, guys.
Jeffrey,
it'll be interesting.
I want you to do a Neil Ferguson. If we get a 1/4 point rate cut, what actually happens?
Well, this is a common thing people say to me, Thomas. Say, 1/4 point won't do anything for the labor market. And my response to that is, well, why don't we just try anyway? Let's just give it a chance. I mean, it does have an impact. If the bond market senses out that the direction of travel for the overnight rate is, another 100 basis points lower or more over the next year, that will feed through into 10-year yields. That will affect corporate borrowing costs. That will also feed through into mortgage rates. I think
that's
Paul
what
earlier mentioned.
Paul Sweeney says.
Yeah.
Exactly. Yeah, exactly. So it will have an impact. It's not just the 25 basis point fine tuning. It's more than that.
Jeffrey, thank you so much. This has been great. Just thank you for this jobs report coverage. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
So here's the real world, folks. I'm in a speech or whatever, and there's some young cherub who says, when did life change? Life changed with David Malpass. I can tell you exactly when it did. Something called LIBOR OIS went out 4 standard deviations. I'm in the show. The place is chaos, top to bottom. A Thursday in August of 2007, and I didn't scream, Paul. My usual charming way.
Good.
Like HR approved. Yep. Get Alan Meltzer, get David Malpass. And it was a magical show, one of the iconic moments within all that we're doing here at Bloomberg. Mr. Malpass went on from Bear Stearns, where he was definitive in writing essays on the American experiment, to his public service at the World Bank. Can I just say you look tanned and rested after the grind? What's the biggest grind of public office that we don't see?
It's good to see you, Tom and Paul. But the grind is the travel. These conferences are constant, and I said no to each of the conferences. I didn't go to Davos.
And your staff said yes.
People say, but this is your responsibility, and so you travel, and nothing happens at the conferences. So I was happy to see President Trump on this latest the G20 going on in South Africa say we're just not sending people because they don't do anything that's useful.
I want to cut to the arch Malpass issue, which is the physics of 2 Americas. We have an America that's booming. Paul and I do it every single day. We have an America being left behind. On an historical basis, how separate are we right now?
I think call it inequality, or that underperformance by the bottom is massive. Whether from a data standpoint, it's the worst, but what we need is job growth at the bottom and median income growth. That is the whole concept of a good economic policy. I did that around the world. That the way we evaluate whether an economic program is going forward is the median income, the income of people in the middle after inflation going up. And so what we need, or what I think lots of policy changes can help with affordability right now. One that I've written about is what the Federal Reserve could do to stop causing this income inequality. We need a lot more energy production. We need permitting reform, which is really important in Congress. I think a capital gains tax cut would actually enable a lot more capital mobility.
Or see that, Paul, with accelerated depreciation.
Yep, absolutely.
Torsten Slok says that puts a point On GDP.
And very importantly, it puts a point, and that growth comes from small businesses that invest in new machines, which then enable workers and productivity. So it's a virtuous circle that you create from that, and we desperately need that now. I think Trump is going totally in the right direction. The problem is implementation of it, and my worry right now is that the Fed will choke it off.
So that's kind of where you were 2 weeks ago with your opinion piece in the Wall Street Journal talking about affordability. And that was certainly an issue in the elections in New Jersey and Virginia. Is the Fed too slow here in cutting rates to address its influence on affordability?
Yes. And so I did a Wall Street Journal article in June that they should have cut in that June meeting. And wouldn't the world be better if they had cut in June? Because you would have had the growth that came out of that, and the inflation wasn't occurring. People kept saying there was inflation, and it didn't show up. Right. So they would have been able to cut and allow growth. That would have helped the supply chains, and maybe whether or not they could keep going now, anyway, you would have had the benefit of it. And I put in this latest article the cost to the fiscal deficit from them waiting. So the government has been paying way too much interest, and the Fed, of course, itself pays interest to banks for 3 months where the rate was too high. So they can change that, but I'm worried that we've already seen the bottom of the 10-year yield unless the Fed changes its models. They're right now looking backward at inflation, and they're going to have excuses why they don't want to cut anymore.
As a former president of the World Bank, you have a unique view of global trade. What's your view of the tariff policy of this administration and its impact on global trade?
I've emphasized that the trading system was really broken. We were in it thinking that everybody was playing by the same rules, and China wasn't. And you can look back and say, well, when did people figure it out? That doesn't matter. You're stuck in the WTO, the World Trade Organization system, that doesn't work at all when you have the second biggest economy with very aggressive industrial policy. They're using economy of scale. That means if you invest and you're the first mover in a sector, then you wipe out all your competition.
I got to get this in, David Malpass. You don't see this on radio, lucky you. For those of you on YouTube, Malpass has a gold tie on today that looks like the plated gold in the president's Oval Office as well. You are one of the few people that come in here that have been in the trenches of working out of a van, running for public office. In your case, the Grand Old Party. How does the GOP move forward with a centrist tendency? How do the Democrats, the evil Democrats, David, move forward with a central tendency? Where is the center tendency that you've written about for 40 years?
I ran for Senate in New York State in 2010. So it was the Tea Party days. That was the idea that you could create growth with lower tax rates, with different policies, and basically with a giant upheaval in Washington. So that means each department changing so that they stop blocking growth.
Yeah, but look at the president's ratings. I mean, the giant upheaval ain't too popular right now. How do we get back to the centrist politics that you and John Riding and all wrote about years ago?
So I think you have to implement the upheaval that is going on now. And that means in each area, you need more work on the tax code. You need more work on restraining government spending, because Washington just wants to spend all the money in the world. And very importantly, these Fed reforms would allow capital to flow to small businesses. So that's the core of it. It's the same message. And I think it is Trump's basic message, but you have to implement each part of it in each department.
No, maybe that's not happening. David Malpass, thank you so much. Paul, I'm just going to mention this now. The interview of the year, maybe the moment, was Nancy Lazar, talking much like David about at the micro level, we have to create jobs.
Yep, absolutely.
And you do it through incentives.
Yep.
And all.
I don't know. We'll see.
We'll have to see.
We'll get a lot of economic data.
You're enjoying not being in public service?
Thank you, guys. Yeah, that's fine. For one, I exercise more and and don't travel which isn't. I've done it for so many years. It's.
Do you get World Cup tickets? Do you get Special tickets?
Very important. I signed the FIFA ball. So at the G20 in Indonesia in 2022, it was amazing. But Ukraine had already been invaded. There was this big round table, and so Biden was there, and Macron, and everybody, and the FIFA guy was there, and he was the center of attention, and I got signed the ball.
This is great. David Malpass with the FIFA guy. Greatly appreciate it. Mr. Malpass, of course, former president of the World Bank. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
It is a joy to talk to Marta Norton. She's with the Canadians Empower. Full disclosure, they handle the Bloomberg 401k, do a great job on that. They got the little app.
Yeah, I get the app. That works
Triple
awesome.
leverage all cash fund.
Check it out every once in a while.
Up 4.2% this year.
Exactly.
Yeah, but leveraged up 7.3 with the usual Empower. Drop my phone. Yep. The Empower fee. Marta Norton with us here with perspective on the markets. Are people participating in this mental tech rally? Like in the canvas of the billions you people handle? Are people participating in Nvidia and tech?
We have such a great AI story going on right now. But when I think about the questions that I get from clients, there is still a lot of consternation out there. I think there's fear. I mean, the tariff moment was a moment of great fear, I think, broadly for a lot of clients. And then there's still a lot of enthusiasm around alternatives like gold and crypto and people concerned about the U.S. future. So I think people are in financially, but mentally and emotionally, there's still some hesitation and reservation there.
I mean, it's proven once again today, this is an AI marketplace, that's for sure. That the AI narrative, as it were, is still alive and well.
Yeah.
How about diversification into fixed income? How do you try to weave that discussion into your conversation?
Yeah, I would say that after 2022, there was real hesitation on the part of financial advisors, on the part of retail investors, real concern about whether fixed income was a hedge. But what we're seeing this year from fixed income is pretty strong returns, I think, for a lot of folks. Yields are a lot better. I think, there's a lot of, I would say, commentary around is 60-40 dead, but I think it certainly has delivered in 2025. And so with all the doubts, that continue to persist around that type of basic strategy, I don't know if people can throw the towel on it at this point in time.
What's the discussion you guys have with your clients about rebalancing? In terms of you've got some real big winners, let's take a little money off the table. And
he asked this question just to upset me.
Tom.
Why is
He's
this?
not a big fan of the rebalancing thing.
Interesting. So here's my view on rebalancing at this particular moment. I think when we're in a AI moment like this, an innovation cycle like this one, where there is just massive enthusiasm, and maybe rightly so, around what the technology is able to do for the economy. And then those gains accrue to the AI winners at the moment. We have the potential for prices to soar past, with enthusiasm, what the fundamentals say. And then we get these bouts of volatility. And so in my mind, we should talk about rebalancing on a permanent basis, but in a moment like this one, I think it can help save some of the fits and starts for a portfolio.
But I know it's not an Empower opinion, but with all your work, particularly at Morningstar, Marta Norton, the bottom line is the key plug-in to the rebalancing theory is the how often-ness of it. And
Absolutely.
I respectfully would say the street has an addiction to this because it's an excuse to get in front of clients. In the academic study, Paul, across cycles, bear markets, the whenness of it is a huge deal. Do you find it empowered that people are doing it too much? They're moving in, they're trading their 401k.
I mean, we've been playing around with some different studies on rebalancing. And if you're taking a look at like a monthly rebalance scheme and you look at what that would generate, if you're just tracking the S&P 500, you could see a turnover of less than 10% on a monthly basis, but that generates overall turnover about 100% on an annual basis. And
Lisa's
that can really
kids are doing
up.
that on a couch over at Robinhood.
So we're just confirmed once again today, this is an AI-driven marketplace. Outside of that, are you guys looking for value in other sectors? Or, I mean, if you do that too much, you kind of miss out on the performance.
Well, that's true. I mean, it's interesting that if you're a real skeptic on the AI theory and you move out of it completely, you're missing the bulk of the U.S. market gains, right? The U.S. no longer looks so exceptional relative to other markets. I think one thing that I listened to Jeffrey Gundlach's podcast on Odd Lots recently, and one of the things he said is, the market is expensive everywhere. And it's hard from the research that we've done, at least within equities, to disagree, because when we look at valuations, we look at it on this decile basis. We want to make sure that we're only looking at the extremes, because valuations, when they're just modestly high, they're really not predictive of returns. So we want to make sure we're really capturing those extreme moments. And when we do that sector by sector, most of them look to be at extremes.
Let me do a data check here. Marta Norton with us with Empower as we look to the shattered retirement economy of America. Futures up 105, up 80 3 hours ago. They've just really advanced off Nvidia, the tech. A jobs report that came up near 4.5% roundup unemployment. Thank you, Michael McKee, for that. Futures up 103. NASDAQ up 2% right now. VIX coming in with a vengeance, 19.73. The Sweeney yield right now, 3.60. The handle's a 3.56. That really gets my attention there, maybe on a bet of what we'll see in December. I'm sure you know this to 3 decimal points, and you probably can't tell me, but give me a tendency here. How many people at Empower over whatever age are properly funded for retirement? Is it single digit? Or is it, am I too gloomy with that?
Yeah, it's interesting. I think people are, but the narrative around retirement, a lot of people use the word crisis. And I don't know if that's the appropriate word to use. I mean, I think we've seen a really good impact of 401ks on the average person's life. But when you take a look at kind of where the need is, a lot of what you see is just a lack of access. And that really relates more to the small business market than it does to the larger companies. So there's been some really good developments. Having a kind of automated default into a retirement plan, that's been really helpful for a lot of folks. So they don't even have to make an active choice. But not having access to this kind of capability, I think that's problematic.
Marta, we don't care. The only reason you're here is Michael McKee bleeds Denver Broncos orange. Oh, no. You people sponsor the Denver Broncos.
Oh, that's right.
Can you get McKee tickets?
Oh, my
Rockstar Marta Norton tickets to Broncos?
We'll see what we can do.
There we go.
The strings.
That's what we want. Marta Norton, thank you so much. Out of Denver, and of course, all of Canada with Empower. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We are lifted by the newspapers. Here's Lisa Mateo.
You got it. It's a big day, okay? First round of bids for Warner Brothers Discovery expected today. Competition, they're putting all their final touches on their offers. Okay, so you have Paramount, Skydance, Comcast, Netflix, all in the running. Comcast, Netflix, most interested in film and TV. Paramount wants to buy the whole company. They put in 3 offers already, running as high as about $23.50 a share. The new thing for this story is that Bloomberg's reporting that Netflix is changing the tune a little. They told Warner Brothers they will keep releasing their films in theaters if they win the bid, and that's something they did not want to do. So you're starting to see
they only
the tune
want part of the company, right?
Yeah, Netflix would prefer just the studio and HBO Max, the content side. They don't necessarily want the cable network business. That's not the business they're in, but that's okay. That structure's fine too. I think with Warner Brothers Discovery, they just have to figure out what's going to maximize total value for the company. Is it just
price at the end of the day?
Always. I think it is.
It's just price.
Yeah, because you have a seller here that's a willing seller. Warner Brothers Discovery, their board and their CEO is committed to sell the company. Now it's just about price.
Okay, can I editorialize further? Paul, Is this just about John Malone? Is he the one driving the bus?
No. This is really about, I would say, Mr. Ellison and his father. I think that's the real variable here. How much equity do they want to put in, and how much equity can they attract to fund their bid? Because Warner Brothers Discovery is three times the size.
They did Landman.
They did Landman.
That's the only reason.
Exactly.
Next.
Okay, this one's in the Wall Street Journal. When is it time to retire? That's the question it puts out there. And it gives 10 reasons, like 10 signs to look for.
These hit close to home, dude.
I know. Okay, the first one they say is if you arrive at work and you feel a little bit numb more than like once or twice a week, which means that you're unhappy and you're unfulfilled. Okay.
All right.
Here's another one for you. If you lose your desire to keep up with the new tech tools.
That one hit home. One hit home.
Here, learn this new software thing. Okay, wait, next week we're going to learn this one. And next month we're going to learn this one. Okay,
that one
if that kind of bothers you a little bit, okay, that's a sign.
Si, would you get out the newspaper hook, please?
Oh, we're not done yet. Okay, if you get the Sunday scaries, this is like if Sunday night when you're getting dinner ready and you're already starting to feel the jitters, like, Monday's coming, okay? If you notice and you look around the room and you say, where are all my peers?
Yep.
They're gone, and you're the oldest person in the room. What then? That's another sign, okay?
Especially here at Bloomberg.
The control room. It's the first time I've ever seen a control room sit up and lean forward.
Yeah.
You guys are loving this, huh?
I got one more for you.
Okay, go.
Okay, ready? If you notice that you're walking around the halls and your body aches, right? Your knees are aching, all of a sudden your joints, and you're walking around.
That started right at 50.
Ooh, okay.
Did Mr. Bloomberg plant this?
Yeah, exactly.
It's the Wall Street Journal, I swear. Check it out. It's pretty interesting.
Next,
Okay,
please.
here's a hint for you. Believe it or not, we know who purchased that gold toilet bowl at Sotheby's. There's your hint. Yes, Ripley's Believe It or Not did. Yes, it was for $12.1 million. They talked about it as one of the wildest acquisitions in its history. Now, the company hasn't decided where they're going to use the toilet. Their intention is to display it. But here's the zinger. It's even considering whether visitors may someday be allowed to use it.
There you
go. So you might be able to go give a little flush and have at it. But that's what they're saying. So it priced the toilet based on the equivalent value of gold. Ripley's paid that another $2 million of premiums to Sotheby's on top of it. So it was a big purchase. But now we know who bought it. See?
Lisa Mateo.
The story that keeps giving.
The newspapers.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.